Good afternoon. This is Tom Alexander. It is Saturday, July 20th. It is about 1:15 p.m. Eastern Time on Saturday in beautiful Charleston, South Carolina. This is the weekend stock market update. I do cover other markets, but in this video, I always only cover the stock indices. This is free. You can pick up this and you can pick up the PDF with all the charts and levels that you're going to see. If you go to the website, let me show you that. You go to this website, alexandertrading.com, go to weekly update and click on weekly update. This is free. And then this is the one for this week. This is a midweek update that I did with my buddy Ben Lichtenstein this week. That I think is also interesting. But anyway, you can go back, gosh, I don't know, a year plus, and peruse through these weekend updates, see what I was saying at that time, and then you can see if you can go forward and see if you think I know what I'm talking about, and if this might be a valid methodology for you. Everything I do is through the lens of price action, through the lens of auction market principles of development that are immutable. I certainly use the market profile graph. A lot of people find me through market profile. I've been using market profile since it was initially posited by Stellmeyer back in the mid-1980s. And I won't get on my soapbox here, but market profile is a graphing format. It's not an end in itself. It's a means to an end. And it helps to properly use, helps to identify market condition, that market condition being an auction market condition. So enough of that. Where are we? Interesting week, huh? Okay, let's just go through some charts. I'm going to go through the primary indices that we trade. Now, one of the things that's fascinating to me is that in each of the retracements you see, you're going to see that the indices have experienced so far off of last week's all-time high in the case of SPX, NDX, and Dow and New York Composite are pretty benign, and it's just normal stuff. I don't know what people are thinking that you're not going to have a 3 or 4 or 5 or 6 or 7% retracement occasionally in a bull market. And so far, you have to give the benefit of the doubt that this current retracement is nothing more than a normal retracement within a bull market that you're going to get. So far, the SPX has pulled back just a little bit more than 3%. The important downside level below here is this level of 54.46. Now, something else, and I repeat this almost every week, I don't use magic numbers, specifically Gann. I use basic things, trend lines, and previous auction points. An auction point is something that occurred between buyers and sellers. And when it occurs often between buyers and sellers, the market itself is identifying that level as important. And that's what we have here at 54.46. You can see all these lows that hit in this. It was the low extreme of a balance area that formed prior to this ramp that we had higher that began at the beginning of July. So right now, there is nothing between where we closed on Friday and this level. That doesn't mean we necessarily go there. It doesn't necessarily mean we stop there. It is an inflection point, though. Frankly, I'll be a little bit surprised if we just slice through it, but we'll see. It is a level to keep an eye on, a very important level to watch, and it's one that can be objectively identified. Okay, let's take a look at the NDX. Which in a week's time, if you look at my written report, it's fascinating for me to watch the analysts on CNBC and on X come in, and in 1 week's or week and a half in the case of the NDX, we've gone from you just have to own this and close your eyes and buy it, and the multiples don't matter, the earnings don't matter, it's all going to grow into that. This is the beginning of the AI trade. Blah 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 blah, and all of a sudden now we're down 6% and regular. Well, I'm not sure the AI trade didn't get out. Okay, it's always hindsight. Now the NDX is at the equivalent level that we just showed for the SPX. The NDX low was actually in late June, not early July. This was the SPX low here on July 1st. But we'll see. I mean, it's, the NDX is certainly retraced now, not quite 6%. Could it go down more? Absolutely. Do I think this is the beginning of a bear market? No, I do not think that. But I could be wrong. We'll talk about that in just a minute too. The Dow, let's go to the Dow. The Dow had a furious rally out of this balance area. At the same time, the Russell did, which we'll take a look at next. But it's only off. It's off less than 3% from its print high last week that occurred on Thursday. This 4,000 level was the breakout level to the upside, so it'll be an important level that could be tested next week to the downside. And let's look at the New York line. Let's save that one. Let's go to the Russell. Okay, the Russell, I talked about this. You can go back and look at the weekend reports. I talked about this balance area in the Russell for weeks and the importance of the breakout, and that if it broke out, it could be potentially very bullish for the overall bull trend in the stock indices because it would reflect a broadening out of the market. And that's exactly what we had. Now, we've come in a little more than 4%. We'll see what happens from here. This is not an all-time high in the Russell. It's a multi-year high, but not an all-time high. But right now, and this is something else that is different than we've seen over the past year. Everything is trading in lockstep. The Russell, the New York Composite, the NASDAQ Composite, NDX, the SPX, all the indices are trading in lockstep. That's the correlations had the typical correlations had completely broken down. I think it could be positive for the market if those correlations now are getting a little more normalized. Now, that doesn't mean everything goes up the same percentage every day or down the same percentage every day, and you don't have these short-term divergences. But in general, in strong bull markets, and you can go back, and bear markets, you can go back and look at this yourself, all the indices will move substantially in the same direction at roughly the same time. And that has not been the case for the past year. Okay, let's look at the New York Composite, the broadest of the indices that we follow. This is every stock listed on the New York Stock Exchange. We had the big breakout, and now we're having a pullback. The pullback's only 2%. So what you've just seen, the largest retracement that we've had so far has been in the NDX, which is 6%, which again, in a bull market, it's just, it's a nothing burger. So, remains to be seen if this is to be the end of the great bull market and the beginning of the great bear market or not. And we're going to talk about I'm going to look at one more thing that's immediately relevant, and then we're going to go back and look at some charts, some historical charts in bear markets. And I want to point out some things that are more likely to occur than not, even if we are in a bear market. But let's take a look at this page. And in particular, I want to look at VIX. VIX spiked last week up to about 16.5. The last time we were at this level was back in April, and we spent about 6 trading days at 16.5 or above, and then the market cratered. Now, this was at the same time frame that we saw the SPX having a bit of a retracement itself, and that retracement lasted about, it was about a little less than 6%. Well, we're what? Not 3%, half that so far. So are we going to go lower? Could VIX spike higher from here? Absolutely. If we do go lower, VIX is likely to spike higher from here. But this is just some recent reference for how this market is trading and what its personality has been in the deepest retracement we've seen since the market took off in last October, last November. So it gives us something objective to keep an eye on. Okay, now let's take a look. What if you're wrong, Tom? What if the This is the beginning of the all-time Armageddon grand super cycle, wave 55555 high, and the market's going to zero. What about that, Tom? Well, okay, if that happens, it's probably going to take a couple different forms. One thing that has to happen if we're going to zero is, first of all, downside levels have to be taken out. So if you want to sell the farm and your father-in-law's farm and bet it all on a market crash, then I would put a sell stop here below 54.46 and at least let the market put me into the trade. So this is, the point here is that some level will have to be taken out to the downside. This is an inverted V top. It's the market, unless it crashes, unless there's something that has never happened before, you're going to have a market that makes a series of lower lows and lower highs on the way down and takes out this level. Now, I've been trading since the mid-1980s, and I have traded every single bear market that I'm about to show you. So let's start with the first one I traded, and that was in 1987. Okay, here we go. 1987. I have a lot of stories about this time period. And this was October 19th. Let's see, right here. This was Monday, October 19th. Now, I traded this entire move beginning back in 1985. And I watched every single tick the day of the crash. I still have the chart that I was plotting by hand during this time frame, by the way. But anyway, so what happened on October 19th? Well, basically, this was a bear market that lasted, let's see where. Let's see, how many days did this last? It lasted a little over 40 days if you take this entire thing. Now, the crash part of this only lasted, get rid of this. This bear market lasted 11 trading days, basically, if you don't count this. Now, I want you to notice something here, a couple of things. First of all, the levels that were taken out, you took out this level, and then you traded down to here, and then you had this retracement. Now, how much was that retracement? It's you'll typically retrace these legs something around 50%. Yeah, you had this first leg was retraced 50%. And then you double bottomed, you came up here and you just cratered. Well, what happened in the crater? Well, you took out this level. So that's why I say this 54.46. If you're in a dither because you're going to miss the great crash and you want to be on board, at least let the market take out 54.46 before you panic. And then you had this 10, 11 day move down from here. And then you had a more typical market, a choppy, churning market. Well, you did have a big retracement. Now, I don't think this was 50%. It wasn't. It was probably 40%, 38%, something around one of your typical fib retracements. But and then you tested this, et cetera. All right, now let's go. And the point of this is the market is going to be rotational. And if it's not rotational, this was the world's greatest buying opportunity down here. So it's one or the other. So there's no reason to panic if you miss a waterfall 10-day decline. Okay, on day 11, you have the greatest buying opportunity of your lifetime. Okay, let's go to the 2000 bear market. Everybody thinks that, everybody says, well, gee, the market fell 35% in one day in 1987, it fell 50% in 2000, it fell 50% in 2008, it fell 50% in 2020. I'm going to get rich because I'm going to call the top and I'm going to get short and cash out at the low. Well, it never works that way. It doesn't work that way. Okay, so this was the top of the SPX. Now the indices topped differently here. I'm using the SPX. That's a different topic, but the other indices basically followed this same pattern. You can go back and see for yourself. So we had this big drop in the SPX off of this high into here, and then look, you have this giant retracement. And actually, we retraced 90% of it. And then you had another drop, and again, more than a 50% retracement. Then you had another drop, more than a 50% retracement. Then this was almost retraced 100%. And then you had a big drop here. And this was probably 62, 70% retracement, et cetera. So all the way down. Now, and this, to me, if we're in a bear market, I'm just going to say thank you very much, because to me, they're much easier to trade. In a bull market, you get these grinding, relentless rallies that go on for months and months and months and months. And you have these tiny 1% and 2% retracements that last 7 trading hours, and then your new all-time highs. Bear markets, you have furious declines, you have furious rallies. And and also things like breadth and the relationship among the indices become much more helpful in terms of indicators and tells as to what's going on. So this was 2000. Let's go to 2007. And here you go. This was the top right here. Initial bottom, giant retracement, then another leg down, depending on where you want to draw it, 50%, that's another retracement. And then you had double bottomed here, and this was an even deeper retracement. And really the sharpest move here occurred in about 5 trading days in October of 2008. And even that, so if you count it from here, even that was retraced over 50%. Then you had another leg down, huge giant retracement. So if we're in a bear market, again, I'm just going to say thank you very much. And if you are a trader, you trade the market in front of you. Don't get hung up on calling tops and bottoms. You know, you have to have a trade plan that has an expectancy. It helps to be it's extremely helpful to identify market condition, no doubt. It's extremely helpful to understand this auction market process of development that price follows. We are trading auction markets. There are certain precepts under which auction markets have to trade. And this creates patterns. These things play out. Now, it's not a paint by the numbers approach. It requires some judgment. It requires some experience. Sometimes you're wrong, but there is nothing that is more consistent, more objective across any milieu, any exogenous backdrop, political, geopolitical, whatever. So that, my friends, is the update for this weekend. Next week should be quite interesting. I think we will see at least a short-term low probably by Tuesday. But if we don't, we'll take a look at it and try to figure out what's going on. You guys have a wonderful weekend. I'll speak with you again soon.